Hello everyone and thank you for watching Edupedia World videos. And today's class will do Unit 3 of Chapter 1, that is Basis of Charge and Rates of Taxes. We'll get to know what is the basis of charging income tax on the income earned by an assessee and what are the different rates at which different classes of assessees are charged. So let us continue with today's class. First of all comes the learning objectives. What are the learning objectives for today's class? Number 1, understand the basis of charge of income tax. We'll get to know in today's class that what is the basis of charging income tax on the total income of an assessee. What are the various provisions and charging sections of the income tax? Number 2, we'll know the rates of taxes applicable for different classes of assessees. There are different rates applicable to different assessees. So we'll get to know all the rates of taxes applicable for the assessees. Number 3, we'll know whether surcharge is applicable to a particular class of assessee and if so, the rate of surcharge and the level of income above which the same is applicable. What this point means is that we'll first of all understand what surcharge is and then we'll understand that on what class of assessee this type of tax, surcharge is a type of tax, so this is levied on which particular class of assessee, and if it is leviable on certain class of assessee, what is the rate of that? And after that we'll know that what is the level of income above which the same is applicable. Okay, so we'll know that we'll know everything about the surcharge. Number 4, understand the concept of marginal relief. There is one section in the Income Tax Act 1961 about the marginal relief. We'll just understand that, what does that mean, and at the end we'll know about the education cess and secondary and higher education cess. What are they? So let's start with the class with the first learning objective, that is the basis of charge of income tax, and then gradually we'll proceed to the remaining learning objectives, and at the end of the class we'll able to understand all these objectives very clearly and the concepts will be clear about all these points. So first of all comes the charge of income tax. How is income tax charged and what is the basis of charging income tax on the total taxable income of an assessee? The Income Tax Act 1961 contains all the provisions regarding the charge of income tax in section 4 of it. So, section 4 is the charging section of the Income Tax Act. The various points given on the section 4 are as follows, and these are the points which we need to keep in our mind so that we can apply the various rates of taxes on the different classes of assessees. These are the points which should be remembered for charging of income tax on the taxable income of any assessee. So let us go through them one by one. What does section 4 contains? Number 1 is tax shall be charged at the rates prescribed for the year by the Annual Finance Act. Meaning, every year the Finance Minister presents the Annual Finance Act. So in that act, the Finance Minister prescribes the different rates applicable to different assessees for the year. So the rates prescribed by that Annual Finance Act will be the rates at which the income tax will be charged on the taxable income of any assessee. So the rates are given by the Annual Finance Act. Number 2. The charge is on every person specified under section 231. We have learned the definition of person in Unit 2 of this chapter, that is important definitions of Income Tax Act, and in that we have learned that the term definitions is the term person is defined and is classified into various subcategories. So a person means an individual, HUF, firm, company, AOP, BOI, local authority, and artificial judicial person. So all are the types of different types of persons. So the charge is leviable upon each of them. The Annual Finance Act contains the rates of taxes chargeable on every person specified in section 231. So the finance minister gives rates for the charging of income tax for each class of person, whether it be individual or HUF or company, etc. Individuals will be charged at different rates, HUF at different, companies at different rates. All the persons will be chargeable to tax at different rates contained in the Annual Finance Act. Number 3. Tax is chargeable on the total income earned during the previous year and not the assessment year. This is a very important provision which we need to remember. We haven't gone through the concept of previous year and assessment year till now, but in the next class we'll do that. But for now on, you just need to remember, just for the sake of charging section, that tax is chargeable on the total income earned during the previous year and not the assessment year. These are two different things. The previous year is a different year and an assessment year is a different year. So for just now, you just need to remember that the tax is chargeable on the income earned in the previous year. You just have to remember this. And there are certain exceptions also to this section, that is the income earned in the assessment year is chargeable to tax. The normal provision is that income earned in the previous year is chargeable to tax. But there are certain exceptions to these provisions, which is that the income earned in the assessment year only will be chargeable to tax. All these sections also we are going to do in detail in the coming classes. That is section 172, 174, 174A, 175 and 176. All will be covered in the next class. So for now on, you just need to remember that tax is chargeable on the total income earned during the previous year. Number 4. Tax shall be levied in accordance with and subject to the various provisions contained in the Act. So the income tax should be levied in accordance with the provisions contained in the Act. We have to just follow the provisions contained in the Act while charging the income tax. All these provisions and all those sections need to be followed for the charge of income tax. We cannot go against the provisions and charge income tax. We have to be in line with the provisions of the Act, and accordingly we have to charge income tax. There are various provisions of charging section given in the Act, so we have to follow them and accordingly charge income tax on the total income of any assessee. Number 5. This section is the backbone of the law of income tax insofar as it serves as the most operative provision of the Act, meaning that until and unless this section is there, how will charge income tax? And this is the main thing of the income tax, the charging thing. The Income Tax Act contains so many provisions about income and various other things. So all these things will be of no use until and unless there is a charging section, until and unless the income tax is charged on those income and on those things given in the Act. The Income Tax Act is of no use. The main thing, the basis, the backbone is the charging thing. The charging thing of the Income Tax Act, which is the revenue generation thing of the government. Until and unless the income tax is charged on the income, the government will not be able to generate its revenue. Next comes the rates of tax. What are the different rates of taxes applicable to the different types of assessees in the Income Tax Act? All the different types of assessees are chargeable to tax at different rates. No two assessees or types of assessees are chargeable at the same rate of tax, and all these rates are given by the Annual Finance Act presented by the Finance Minister every year. So every year the rates of tax for different assessees are prescribed, whether they are changed or whether they are increased or decreased, whatever be the case, but every year they are prescribed by the Finance Minister. So let us see the various slab rates and various rates of taxes applicable to various assessees for the assessment year 15-16, that is this assessment year which is going on. Let us see that. First comes the slab rate for individuals. What are the different slabs as per the Income Tax Act, according to which the income of an individual is taxed? This is the slab given according to which the income of an individual is taxed. We all know the definition of individual. Who all are included under the definition of individual? So for them, this is the slab as per which the income will be taxed. Where the total income does not exceed 2,50,000 in an year. So if I am an individual and I am earning 2,50,000 and less per year, my income for the year does not exceed 2,50,000 after giving effects to all the provisions of the Income Tax Act, all the deductions and all the rebates, whatever are there, my income comes to 2,50,000 or less. So I'll not be liable to pay any tax on that, and the rate at which I'll be charged will be nil. So if I'm earning 2,50,000 and less, I don't have to pay any tax. When my income exceeds 2,50,000 and is within the range of 5 lakhs, that is, my income comes within the range of 2,50,000 and 5 lakhs, then I'll be liable to pay 10% of the amount by which the total income exceeds 2,50,000. Just pay attention to this point, what is given. For example, if I am earning 2,60,000, my income for the year is coming 2,60,000 after all the calculations. So, till 2,50,000, my income will be exempt, and whatever income is over and above that 2,50,000 will be charged at the rate of 10%. So, what is the income over and above 2,50,000? That is 10,000. 2,60,000 minus 2,50,000. So 10,000 will be charged to income tax at the rate of 10%. So that will be equal to 1,000. So I'll be liable to pay only 1,000 as income tax to the government. Now comes when the total income exceeds 5 lakh and does not exceed 10 lakh. So when my income is ranging between 5 lakh to 10 lakhs, I have to pay income at the rate of 25,000 plus 20% of the amount by which the total income exceeds 5 lakh rupees. The total, just look at this point, the total income coming under point 2, that is 2,50,000 and 5 lakh, was the difference between both the upper limit and lower limit was 2,50,000, and when we apply 10% to that, it comes to 25,000. So when we move to the third category, first of all we'll add 25,000 and then we'll add 20% of the amount by which the income exceeds 5 lakh. So now if my income is 5,50,000, I'll pay tax at the rate of 25,000 plus 20% of 50,000, and that will come to 10,000. So total income tax which I have to pay will be 35,000. You all are getting my point? How this is working, how this slab is working. The first category people are not required to pay any tax. The second category, people ranging from 2,50,000 to 5 lakh are required to pay tax at the rate of 10% of the amount by which the total income exceeds 2,50,000. The third category of individuals ranging whose income ranges from 5 lakh to 10 lakhs are required to pay income tax at the rate 25,000 plus 20% of the amount by which the total income exceeds 5 lakh. Now the last category where the total income exceeds 10 lakh. So then the rate will be 1,25,000 plus 30% of the amount by which the total income exceeds rupees 10 lakh. So if my income is 11 lakhs, I am required to pay income tax at the rate of 1,25,000 plus 30% of 1 lakh. So that is equal to 1,25,000 plus 30,000 equals to 1,55,000. So this is how all it works. As we proceed to higher and higher income, the rates of income tax increases gradually, and this is how it works. This is the slab for individuals who are below 60 years of age. All individuals, whether male or female. This slab rate is applicable to their income for assessment year 15 and 16. So in the next slide, we'll just go through one example how this slab works. Let us understand the slab rate of individual by this illustration. Mr. X has a total income of rupees 12 lakhs. Compute his gross tax liability. Mr. X is earning rupees 12 lakhs per year. So what is the amount of income tax he is liable to pay? Mr. X is coming under the last category given in the slab, that is when the income exceeds rupees 10 lakhs. So what was the provision for that category? What was the rate for that category? It was 1,25,000 plus 30% of the amount exceeding rupees 10 lakh. So here it is 12 lakh. So 2 lakhs is the amount exceeding over and above 10 lakh because his total income is 12 lakh. So what his tax liability will be? 1,25% plus 30% of 2 lakh. So it is coming up to 1,85,000. This is the simplest way we can calculate it. Alternatively, we can go through from the starting of the slab till the end and get the answer. But I'll suggest that you just learn the slab and calculate the tax liability directly. We just know that okay, Mr. X is coming under the last category of individuals, that is where the income exceeds rupees 10 lakh. We know what is the rate. It is 1,25,000 plus 30% of the amount exceeding 10 lakhs. So accordingly, we can calculate very easily the tax liability. We can go the other way also. In that, we'll just start from the beginning of the slab from 2,50,000. So for the first 2,50,000, Mr. X is not liable to pay any tax. For the next 2,50,000 to 5 lakhs, he is liable to pay tax at the rate of 10%. So 10% of 2,50,000 is 25,000. Now, for the next 5 lakh to 10 lakh, he is liable to pay income tax at the rate of 20%. So 20% of 5 lakhs is 1 lakh. And the balance, that is 12 lakhs minus 10 lakh, 2 lakhs. On 2 lakhs, he is liable to pay income tax at the rate of 30%, which is coming up to 60,000. So we'll add up all these amounts, that is 25,000 plus 1 lakh plus 60,000. So it will come up to 1,85,000. So these are the two ways in which we can calculate the tax liability. Either we can just directly apply the slabs given, like the rate given opposite the category of individual, like okay, 10 lakh exceeding 10 lakh, Mr. X is coming under the category of exceeding 10 lakh. We can directly apply the rate given there, or we can just proceed step by step and get the answer. Whatever way you are comfortable, you can calculate it. So this is the way we'll calculate the income tax of individuals according to the slab given. Up to 2,50,000 nil, we don't have to pay any tax. 2,50,000 to 5 lakhs, we have to pay 10% of the amount exceeding 2,50,000. 5 lakh to 10 lakh, we have to pay 25,000 plus 20% of the amount exceeding 5 lakhs. And the last is income exceeding 10 lakh, we have to pay income tax at the rate of 1,25,000 plus 30% of the amount exceeding rupees 10 lakhs. It is to be noted that for a senior citizen being a resident individual who is of the age of 60 years but not more than 80 years at any time during the previous year, the basic exemption limit is 3 lakh. As I told you in the previous slide that the slab that was given was for individuals who are below the age of 60 years. So the individuals who are above the age of 60 years and below 80 years, the basic exemption limit for them is 3 lakh. For individuals below 60 years, it was 2,50,000, and for individuals above 60 years, it is 3 lakh. Further, resident individuals of the age of 80 years or more at any time during the previous year being very senior citizens would be eligible for a higher basic exemption limit of 5 lakhs. Now, for senior citizens falling under range of 60 to 80 years, the basic exemption limit for them is increased from 2,50,000 to 3 lakh, and for very senior citizens, that is individuals of 80 years and more, the basic exemption limit is further increased to rupees 5 lakhs. Therefore, the tax slabs for these SSC would be as follows. So this is the slab rate for senior citizens, that is individuals who are above the age of 60 years and below the age of 80 years, where the total income does not exceed 3 lakh. No amount of income tax is required to pay. The rate is nil. Next is where the income exceeds 3 lakh but does not exceed 5 lakh. That is, the income is ranging between 3 lakhs to 5 lakhs. The income tax rate will be 10% of the amount by which the total income exceeds 3 lakh. So if I am earning 4 lakhs rupees, so I will be liable to pay income tax on just 1 lakh. That is 4 lakh minus 3 lakhs at the rate of 10%. So 10% of 1 lakh, that is 10,000, will be the amount of income tax liable to be paid by me. The third category is the income where the income exceeds 5 lakh but does not exceed 10 lakhs. That is, the income is ranging between 5 lakh to 10 lakh. Then the amount of income tax required to be paid by me will be 20,000 plus 20% of the amount by which the total income exceeds 5 lakh. Here also the same logic will be applied as we applied in the slab rate for individuals below the age of 60 years. That is, we calculate the total income tax liability of the previous category, that is 3 lakh to 5 lakh, the total liability comes to 20,000. And then we'll add 20% of the amount exceeding 5 lakhs. So if I am earning 6 lakhs rupees, my liability will be 20,000 plus 20% of rupees 1 lakh. That is 20,000. So total tax liability will be 20,000 plus 20,000 equals to 40,000. The last category is the category where the income exceeds 10 lakh. The total income exceeds 10 lakh. So what is the amount of income tax to be paid? 1,20,000 plus 30% of the amount by which the total income exceeds 10 lakh. The same way in which we did in the previous slab. 30% by which the amount exceeds 10 lakh and plus 1,20,000 will be the total income tax liability if my total income exceeds rupees 10 lakh. So if I am earning rupees 11 lakhs, so the income tax liability for me will be 1,20,000 plus 30% of 1 lakh, that is equal to 30,000. So total liability will be 1,20,000 plus 30,000 equals to 1,50,000. The calculation and the basis of calculation is the same as we discussed in the previous slab. Just in this case, the basic exemption limit has been extended to rupees 3 lakh. In individual below the age of 60 years, it was 2,50,000, and in individuals above the age of 60 years and ranging till 80 years, the basic exemption limit is 3 lakhs, and all the other provisions are the same. That is, the income tax rate is gradually increasing as our income is increasing from 10 to 20 and 20 to 30. Now comes the tax slab for the individuals of age of 80 years or more at any time during the previous year. We are done with individuals aging less than 60 years, and then we did it for individuals who are between 60 to 80 years, and now is the tax slab for the individuals who are aging 80 years or more, that is super senior citizens. So what is the tax slab for them? The basic exemption limit for them is rupees 5 lakhs. It was 2,50,000 in case of individuals who are less than 60 years. It was 3 lakh in case of individuals who are above 60 years, and now in case of individuals who are 80 years and above, the basic exemption limit has been further increased to rupees 5 lakhs. So that when the total income of an individual aging 80 years or more is 5 lakhs or less, the income tax payable by them is nil. That is, no income tax is required to be paid by them. And when the income exceeds 5 lakhs and ranges up to rupees 10 lakhs, the percentage of income tax liable to be paid is 20%. The person is liable to pay 20% of the amount by which the total income exceeds 5 lakhs. So if my income is rupees 6 lakhs, so I am liable to pay income tax on the amount exceeding rupees 5 lakhs. So that is rupees 1 lakh. So the income tax to be paid by me will be 20% of rupees 1 lakh, that is 20,000 rupees. You get my point? Okay. So, and the last category in this slab is when the total income exceeds rupees 10 lakhs. So when that happens, the rate of income tax will be 1 lakh plus 30% of the amount by which the total income exceeds rupees 10 lakh. So the logic and the procedure is the same, just that the basic exemption limit is changed and nothing else, just that. And in this, one more change is that the 10% slab is not there and the taxation rate starts from 20% directly. So that is the only change from the other two tax slabs. All the other things remains the same. So when the income exceeds rupees 10 lakh, the income tax liability will be 1 lakh plus 30% of the amount by which the total income exceeds rupees 10 lakh. So if I am earning rupees 12 lakhs, my income is 12 lakh for any year. So I will be liable to pay income tax is equals to 1 lakh plus 30% of the amount exceeding 10 lakh, and that is 2 lakhs. So 30% of 2 lakhs is equals to 60,000. So total income tax liability will be 1 lakh plus 60,000 is equals to 1 lakh 60,000. So this is how the slab of super senior citizens work. Basic exemption limit is exceeded and increased to 5 lakhs. After the individuals, we come to the tax rate applicable to other different types of assessees. For example, firms, local authority, cooperative societies, company, etc. So now we'll do the income tax rates applicable to these assessees. In case of firms and LLP, that is limited liability partnership, the tax rate applicable is 30% on the whole of the total income. We have to pay, that is the firm or the LLP has to pay 30% of the total income earned by them during an year as income tax. Local authority, same way, they also have to pay 30% of their total income as income tax. Now comes the cooperative society. The cooperative societies have to pay income as in the same way as the individuals do, like they are prescribed a slab rate for the taxation thing. They have to pay tax as per the slab. In their slab it is where the total income exceeds, like does not exceed 10,000, 10% of the total income. Where the total income exceeds 10,000 but does not exceed 20,000, 1,000 plus 20% of the amount by which the total income exceeds 10,000, and where the total income exceeds 20,000, 3,000 plus 30% of the amount by which the total income exceeds 20,000. So individuals, the same way as individuals are given a slab according to which they are taxed, cooperative societies are also taxed in the similar way, like progressive taxation, 10%, 20% and 30%. As the income exceeds, the rate of taxation increase. This is not the case with firms, LLP, local authority and companies. They have to pay a flat rate of income tax on their total income. So this is the major difference between taxation of cooperative societies and firms and LLPs. Now comes company. In case of domestic company, 30% of the total income, and in case of a company other than domestic company, 40% of the total income is payable as income tax. So these are the rates prescribed by the Annual Finance Act for the assessment year 2015-16 for different types of assessees like individuals, firms, local authority, cooperative society and companies. Apart from these rates, certain types of incomes, as we'll discussed in the other slide, the income tax has prescribed specific rates. What are these types of income and what are the specific rates, we'll go through in the next slide. The first such other type of income is long-term capital gains. Section 112 has prescribed the rate of tax at the rate of 20% in respect of such income. We have learned about the different heads of income. In that, one head of income was capital gains. So under capital gains, there are two types of gains: long-term capital gains and short-term capital gains. We'll discuss it in detail when we'll cover the chapter capital gains. But for now on, you need to remember that in other types of income, long-term capital gains is taxed at the rate of 20%. As per section 112. As per section 111A, a concessional rate of tax at the rate of 15% is levied upon short-term capital gains on transfer of number 1, an equity share in a company or a unit of an equity-oriented fund or a unit of a business trust. So, if we want to avail the concessional rate of tax at the rate of 15% on short-term capital gain, we can avail it on the following transactions, on the following transfers. Number 1, transfer of equity share of a company. If I am holding an equity share and I am transferring that and I am earning some capital gain, short-term capital gain on it, then 15% of tax will be levied upon it. Short-term means I am holding that share for 12 months or less. So that will be short-term capital gain. If I am holding it for 12 months or more, then that will be long-term capital gain. A unit of equity-oriented fund like mutual funds and all, and a unit of business trust. But the conditions for availing the benefit of this concessional rates are: number 1, the transaction of sale of such equity share or unit should be entered into on or after 1/10/2004. So here are two conditions mentioned which we have to follow in order to avail the benefit of this concessional rate of 15%. Number 1 is that this transaction should take place on or after 1/10/2004, and number 2, such transaction should be chargeable to securities transaction tax, STT. This is a type of tax which is charged when we do transactions in securities. So if this type of tax is charged upon our transaction, then only we can avail the concessional rate of tax of 15% on short-term capital gain. Got it? So this is 111A on short-term capital gains, 112 on long-term capital gains. Now comes section 115BB that prescribes the rate of tax at the rate of 30% for winnings from 1, lottery, number 2, crossword puzzle, 3,
races including horse race. Number 4, card game and other game of any sort. Or number 5, gambling or betting of any form. So 115BB prescribes the rate of 30%, a very huge percentage of taxation on the following earnings. If I'm earning from any lottery, winning of lottery, winning from crossword puzzles or horse race or card game or gambling, any of those, I'm winning some amount, so that will be chargeable to tax at the rate of 30%. So what did we learn in this slide? What are the other types of income and what are the rates charged? In terms of long-term capital gains, it is 20%, short-term capital gains, it is 15%, and winning from any lottery, crossword puzzle, races, etc., it is 30%. Next comes surcharge. What is surcharge? First of all, we'll cover the cases of individual, HUF, AOP, BOI, artificial person, cooperative societies, local authorities, firms, and LLPs. How is surcharge levied in all these cases? Where the total income exceeds 1 crore, surcharge is payable at the rate of 10% of the income tax computed in accordance with the provisions of para 1, 2, 3, 4 above. What does this point mean? Surcharge is actually an additional tax levied upon the persons whose income is exceeding 1 crore. If the income of any individual or HUF or AOP is more than 1 crore, then an additional type of tax known as surcharge will be levied upon them at the rate of 10% of the income tax computed. Not 10% of their income, but 10% of the income tax computed as per the provisions of their respective class. For example, in case of individuals below 60 years, the income tax will be calculated as per their slab. Individuals above 60 years, the income tax will be calculated as per their respective slabs. So whatever the respective slabs are given for various different SSCs, according to that, first of all, the income tax will be calculated. And after that, 10% of that income tax will be charged as surcharge. So this is how surcharge works. Either the income of these persons will be calculated as per para 1, 2, 3, 4, that is the slabs given and the rates given, or the income from long-term capital gain or short-term capital gain as discussed in the previous slide. If that income exceeds 1 crore, then also surcharge will be applicable at the rate of 10% of income tax. So these are the cases. Either as per the slabs given, their income tax will be calculated if they are earning from salaries or profit from business and profession, etc. Or either they are earning from capital gains or 115BB. So in any case, if their income is exceeding 1 crore, then the income tax will be calculated as per the provisions given in the respective sections, and then an additional rate of 10% of income tax will be levied in the form of surcharge. Marginal relief is available in case of such persons having a total income exceeding 1 crore. That is, the additional amount of income tax payable on the excess of income over 1 crore should not be more than the amount of income exceeding 1 crore. You'll get to understand this point more properly in the next slide when we'll discuss it with an example. What is exactly marginal relief? Here, just try to understand the text that if my income is exceeding 1 crore, then the amount of surcharge which I am liable to pay will not exceed the amount of income exceeding 1 crore. I know there must be some confusion with this text, so let us just do the example and understand this definition more properly. What do we mean by marginal relief? We are done with what do we mean by surcharge and what is the rate of surcharge. Now we'll understand what is marginal relief in case of surcharge. First, let us do the case of surcharge in case of companies, and then we'll understand the marginal relief thing from an example in the next slide. So let us first cover the surcharge in case of domestic companies. In case of a domestic company whose total income is more than 1 crore but is less than 10 crores. So what is the rate of surcharge applicable to those companies? Where the total income exceeds 1 crore but does not exceed 10 crore, surcharge is payable at the rate of 5% of income tax computed in accordance with the provisions of para 5.1 above. We have done para 5.1 above, that is, we have got to know the rate of taxation, rate of income tax applicable to domestic companies, that is 30%. So first of all, we'll calculate their income as per that provisions, and then if their income is more than 1 crore and less than 10 crore, an additional tax, that is surcharge, will be leviable at the rate of 5% of the income tax computed. Then section 111A or section 112, if they're earning any income from short-term capital gain or long-term capital gain and that is exceeding 1 crore or more, then also surcharge at the rate of 5% will be leviable upon them. Again, the case of marginal relief. Marginal relief is available in case of such companies, that is the additional amount of income tax payable together with surcharge on the excess of income over 1 crore should not be more than the amount of income exceeding 1 crore. This is something very tricky which we will be able to understand only through an example. So now finally let us cover the example which will let us understand the marginal relief concept more clearly. Let us take an example on the concept of marginal relief to understand this concept much better way. In this example, there are two companies, Company 1 and Company 2. Company 1 is earning an annual income of 1 crore and Company 2 has income of 1 crore 1 lakh. So, the total tax payable by Company 1 is 30% of 1 crore, that is 30 lakhs, and the total tax payable by Company 2 is 30% of 1 crore 1 lakh, that is 30 lakhs 30,000. Now, Company 1 is earning 1 crore, so there is no applicability of surcharge because surcharge is applicable only if the earnings exceed 1 crore. So, surcharge is not applicable in case of Company 1, but in case of Company 2, though it is earning just rupees 1 lakh over and above rupees 1 crore, still the surcharge will be applicable as the income is exceeding rupees 1 crore. Now, surcharge will be applicable at the rate of 5% on Company 2 only because Company 1 does not come under the purview of surcharge. 5% of the income tax payable. The income tax payable we calculated as 30 lakhs 30,000. So the 5% of it will be 1,51,500. So Company 2 is liable to pay surcharge at the rate of 5% along with the income tax at the rate of 30%. So the total tax payable including surcharge for Company 2 will be 31,81,500, and for Company 1, as there is no surcharge, so the total tax payable will be equal to 30 lakhs only. So now Company 1 is earning 1 crore and is paying tax of rupees 30 lakhs, and Company 2 is earning just rupees 1 lakh more than 1 crore, but it has to pay income tax including surcharge of 31,81,500. Though the income over and above is only rupees 1 lakh, but the income tax after surcharge is going up to 31,81,500. That is, it is exceeding the income tax excluding surcharge by 1,81,500. So here the concept of marginal relief will come into play. In the given example, when the income is 1 crore, surcharge is not applicable. But when the income increases by 1 lakh to rupees 1 crore 1 lakh, surcharge becomes applicable. And although the income has increased by 1 lakh, the total tax payable has increased by 1,81,500. So, As the increase in the total tax payable is more than the actual increase in income above 1 crore, the concept of marginal relief will be applicable in this case. So now you understand the concept of marginal relief. The increase in income over and above 1 crore is less than the total tax payable including surcharge. So if this is the case, the concept of marginal relief will come into play, and the total tax payable including surcharge will be after deducting the marginal relief from the total tax payable. So what will be the total tax payable after the application of marginal relief? The marginal relief will be calculated as follows, that is, increase in tax payable is 1,81,500 and the increase in income above 1 crore is 1 lakh. So the difference of both is 81,500. This is our marginal relief. So the total tax payable including surcharge would be 31,81,500 minus the marginal relief, that is 81,500, is equals to 31 lakhs. So if my income is 1 crore 1 lakh, I will not be liable to pay the tax of 31 lakh 81,500. Rather, I would be only liable to pay 31 lakhs including surcharge. So this is all about the concept of marginal relief. Now comes the application of surcharge on domestic companies whose total income is more than 10 crore. We have done in the previous slides the total income above 1 crore and less than 10 crore, and now comes the case of income above 10 crores. Where the total income exceeds 10 crores, surcharge is payable at the rate of 10% of income tax computed in accordance with the rates given in the Income Tax Act. So, when the income is more than 1 crore and less than 10 crore, the rate of surcharge is 5%. And when the income exceeds 10 crore, the rate of surcharge also increases to 10%. So, the total income tax payable along with surcharge will be 30% plus 10%, that is 33% of the income when the total income of the domestic company is more than 10 crore. This is the case when the company is earning income in the normal course, and the same rate of surcharge is also applicable when the company is earning any capital gains. Here also now the concept of marginal relief comes. We have done the concept of marginal relief in case of income exceeding 1 crore and less than 10 crore. In the same way, the concept will also apply in the cases where the income is above 10 crore. The procedure will be the same. That is, if the income is exceeding rupees 1 crore by a lesser amount, but the income tax payable along with surcharge is more than the income exceeding over and above rupees 10 crore, then the concept of marginal relief will come into play. The calculations and all the things will be similar to the previous case that we have done in case of 1 crore. Similarly, the marginal relief will apply in case of 10 crores. After the domestic companies comes the foreign companies, the application of surcharge on foreign companies. Everything, each and everything in both the companies are the same, just there is a difference in rates. Apart from rates, all the concept of surcharge is the same on domestic companies as well as foreign companies. So let us see what is the difference in rate in both the cases. That is, in domestic companies it was 5% when the income was 1 crore, more than 1 crore and less than 10 crore, and it was 10% when the income exceeded 10 crore. What is the case in case of foreign company? Where the total income exceeds 1 crore but does not exceed 10 crores, surcharge is payable at the rate of 2% of income tax. So, the rate of surcharge is slightly lesser in case of foreign companies. In case of domestic companies, it was 5%, and now in case of foreign companies, it is 2% of the income tax payable. So, the total tax payable including surcharge will be 40% plus 2% of 40%, and that will be the total income tax payable
by the foreign companies. So, as the rate of tax is higher for the foreign companies, that is 40%, so the government has kept the rate of surcharge slightly lower than the domestic companies. So, this is how it is balanced. So, that is the case. 2% is the surcharge applicable to foreign companies. And marginal relief, again the concept of marginal relief comes here also, that is when the income above 1 crore is less but the total income tax payable along with surcharge is more, the concept of marginal relief will come into play and the companies will get the marginal relief if their total income above 1 crore is less but the total income tax payable along with surcharge is much more. Case B is the case of foreign companies whose total income is more than 10 crores. We have done the case of domestic companies whose total income exceeds 10 crore. In that case, the rate of surcharge was 10%, and in case of foreign companies whose income is exceeding rupees 10 crores, the rate of surcharge applicable is 5%. So this is only the difference between the two companies, the rate of surcharge. Apart from that, all the applications will be the same. So the application of marginal relief will also be the same in case of foreign company as it was in case of domestic companies. If my income, that is my income above rupees 10 crore is less and the total income tax payable along with surcharge is much more, then I will get the marginal relief and I will be liable to pay income tax along with surcharge after deducting this marginal relief from my income tax. Apart from surcharge, there is one more type of tax leviable upon income tax in the form of education cess and secondary and higher education cess. So after surcharge, there is one more type of tax leviable upon all the assessees irrespective of their level of income. Unlike surcharge, which is just levied upon assessees whose income exceeds 1 crore and more, education cess and secondary and higher education cess is leviable upon all the assessees, whether their income is below 1 crore or above 1 crore. The amount of income tax as increased by the union surcharge, if applicable, that is, if the income of the assessees increases rupees 1 crore, so surcharge is leviable. So, if applicable, surcharge will be levied and that amount of income tax will be further increased by an additional surcharge called the education cess on income tax, calculated at the rate of 2% of such income tax and surcharge if applicable. Meaning, after we have applied income tax on the total income and thereafter applying surcharge, and thereafter will apply 2% on the total of income tax and surcharge. So this is how education cess is levied. It is levied upon the total of income tax and surcharge payable. Education cess is leviable in case of all assessees, as I said earlier, irrespective of their income, that is individuals, HUF, AOP, BOI, firms, local authorities, cooperative societies and companies. Further, secondary and higher education cess on income tax at the rate of 1% of income tax plus surcharge if applicable is leviable to fulfill the commitment of the government to provide and finance secondary and higher education. So after applying 2% of education cess, 1% of secondary and higher education cess is also levied upon income tax and surcharge payable at the rate of 1%. So total 3% of education cess is levied upon after applying surcharge. So this is a type of additional income tax after surcharge. Education cess and higher education cess payable at the rate of 2% and 1% respectively. And after applying all these things, the total amount which comes will be the final amount payable to the government in the form of income tax. So what all things will be included in the income tax payable to the government? The income tax, normal income tax calculated on total income, the surcharge calculated on an income tax, and the secondary and higher education cess calculated on the total of income tax and surcharge. Now comes the rebate of up to 2000 for resident individuals having total income of up to 5 lakhs. So after just discussing about the various taxes applicable, the government has also thought of providing rebate to the taxpayers. So this is one section introduced recently in our Income Tax Act through section 87A. A rebate of rupees 2000 is awarded to the taxpayers falling under the tax slabs of 2,50,000 to 5 lakhs. We have gone through the various tax slabs of individuals. The tax slabs of individuals below 60 years and those who are falling under the category of 2,50,000 to 5 lakhs are required to avail the rebate of rupees 2000 on the amount of tax they are required to pay. For example, if I am earning 2,80,000 rupees in an year, so what is the amount of tax I am required to pay? 2,80,000 minus 2,50,000, that is 30,000. And what is the amount of tax, the rate of tax applicable to me? That is 10%. So 10% of 30,000 is 3,000. So I am required or I am eligible to avail the rebate of rupees 2000 on it. So what is the amount of income tax finally payable by me? 3000 minus 2000, that is 1000. So this is how it works. So let us read the points one by one. In order to provide tax relief to the individual taxpayers who are in the 10% tax slab, Section 87A has been inserted to provide a rebate from the tax payable by an assessee being an individual resident in India whose total income does not exceed 5 lakh. So if I am falling under the category of individual earning 2,50,000 to 5 lakh, I am eligible to avail this rebate. The rebate shall be equal to the amount of income tax payable on the total income for any assessment year or an amount of rupees 2000, whichever is less. So if I am required to pay tax of 2000, then I'll avail the rebate of 2000. So the final amount of income tax payable by me will be nil. And if I am required to pay tax of 3000, I am eligible to avail rebate of 2000 and net income tax liable to be paid by me is 1000. So the maximum rebate available is 2000. I can get a deduction of 2000 and the remaining amount is to be paid as income tax. So if I am like earning 2,60,000 and the amount of income tax payable by me is 1000, so the total of the income tax will be like come under the rebate and I'll not be required to pay any tax. Consequently, any individual having total income up to 2,20,000 will not be required to pay any tax. Further, individuals having total income above 2,20,000 but not exceeding 5 lakh shall get a tax relief of 2,000. In effect, the rebate would be the tax payable or 2,000, whichever is less. Further, the aggregate amount of rebate under Section 87A shall not exceed the amount of income tax on the total income of the assessee with which is chargeable for any assessment year. Thank you. Hope you found today's class helpful and worthy.